Good evening, everyone. I'm Ashwini. I'm delighted to welcome you all to today's webinar on New Tax Rules 2025. What older adults must know to save more and avoid pitfalls. As tax regulations evolve, staying informed is essential, especially for senior citizens looking to optimize their savings and avoid common tax related challenges. At Via Vikas, we are committed to empowering older adults with financial literacy, ensuring they have the knowledge and tools to make informed decisions. Today, session will provide clarity on the latest tax updates and practical strategies to help you navigate them with confidence. We have honored to have Ms. Bhavika Rajgupta as our esteemed speaker. Ms. Raj is a tax expert at TaxBuddy with over 3 years of experience in direct taxation. She has assisted numerous clients in understanding tax complexities, ensuring compliance, and aligning their financial goals with regulatory requirements. With a deep understanding of ever changing tax laws, she is dedicated to helping individuals minimize their tax liabilities while staying fully compliant. This is a great opportunity to gain expert insights on the new tax regime applicable. During this session, kindly keep your mobile phone on mute to avoid any distractions. If you have any questions, please type it in the chat box. We would ask the speaker at end of the session. Over to you, Ms. Bhavika.
Thank you, Ashwini, for the great introduction. Good evening, everyone. Welcome to this session on tax planning, where we will break down the key aspects of tax planning, income tax, deductions, and exemptions. So let's understand firstly what is tax planning. Basically, tax planning is just how you can reduce your taxes and maximize your savings. As tax planning is not just helping you to save the taxes, but also help you to create your wealth as well. Okay. So today we are going to explore the latest tax changes, especially designed to help for the older adults to maximize their savings and avoid the common pitfalls for the taxes. Today's agenda for the session is to understand the tax reliefs and benefits and how you can optimize your finance for your comfortable retirement. Now, what are the points that we are covering in today's session, which is first and foremost, ITR overview, deduction, and slab rates. So we'll begin with the basic first. What is ITR? Where we will see what is ITR, who is eligible to file the ITR, why it is necessary to file the ITR. Moving ahead to the ITR form. So there are specific 4 types of ITR form, which is ITR 1, 2, 3, and 4. So which ITR form is applicable to you as per your income source, that we will cover in today's session. Moving ahead to the slab rates. So there are particular slab rates as per the new tax regime and as per the old tax regime. So we'll see what are the slab rates for new tax regime and what are the slab rates for old tax regime as well. Lastly, we'll check with the deduction. So there are multiple deduction under section chapter 6A, where you can save the maximum taxes. So we'll see what are the deduction that are covered in this and what is the maximum limit, how much is the benefit you are getting it if you are investing in those schemes or investments. Second, upcoming the thing is the introduction to the senior citizen tax benefit. So, what is tax benefit for the senior citizen? Who is a senior citizen? Who are known as a senior citizen? That we will cover in today's session. And also, what are the provisions that are exclusive for the older adults that we will cover in today's session. Coming up next to the key tax benefit for a senior citizen. So where we will check what are the key tax benefits for the senior citizen in various tax deductions and exemptions. We will also check the budget 2020-24 and budget 2020-25. There we will check what are the budget amendments that are affecting the taxation and what are the changes that has been amended by the government in budget 2024-25. And lastly, we'll go with the tax planning and Q&A, where we will see various types of tax planning strategy and thus various deductions and exemptions for the seniors. And lastly, the Q&A, where we will also have a Q&A session at the end of the session, or you can ask your queries on the chat. My colleague Hetal is also there, so she'll be coordinating or she'll be helping us in case if you have a queries, and if you're asking the queries on the chat, she will address that accordingly. Now, move ahead to our ITR overview and deduction. Here, firstly, we'll see what is ITR. So, ITR is a form that enables a taxpayer to declare their income tax, deduction, taxation, and exemptions. So your basic exemption limit is up to 2.5 lakh. So in case if your income is more than 2.5 lakh, then you have to file the ITR mandatorily. Or if you can say, if you have the income which is more than 2.5 lakh, then it is mandatory for you to file the income tax returns to avoid the notice compliances later on from the income tax department. Moving ahead to the ITR forms. So now selecting a correct ITR form is as much as related or corrected to the correct ITR filing. So in case if you have filed the wrong ITR form while filing the return, that will affect the ITR notice or defective notice after processing the return. To avoid this, you have to file ITR with the correct ITR forms as per your income source. So we'll see what are the ITR forms. As we have already discussed, there are four types of ITR forms, which is ITR 1, 2, and 3, and 4. So first we'll see what is ITR 1 first. ITR 1 is also known as a Sugam ITR. So in case if you have a salary income which is up to 50 lakh, along with the other sources income like saving bank, FD, interest, and other sources income, and one house property income, then you should file ITR 1 for the same. But in case where you have the salary which is more than 50 lakh, then you have to switch to the ITR 2 forms. Secondly, second ITR form is ITR 2. So in case if you have traded in shares, equity, mutual funds, then you have to file ITR 2 for the same. So in case if you have a capital gains from shares or mutual funds, you can report your capital gain. And in case if you have a losses in capital gains or in the capital markets, then you can report your losses accordingly so that it can be carried forward to the next financial or assessment years. Third is ITR 3. So ITR 3 is mainly for the business and a professional incomes who need to prepare a PNL and balance sheet. This also includes the balance. This also includes the presumptive taxation or the other non-speculative trading and speculative income as well. As in, if you have traded in futures and options or the intraday trading, then you have to file ITR 3 for the same. Lastly, ITR 4. So ITR 4 is also known as Sugam ITR, and ITR 4 is for small businesses who don't need to prepare a P&L and balance sheet for the same, and they can report their income easily in the presumptive taxation schemes. Coming ahead to the regimes, as we all know that there are two types of regime. First is new tax regime and second is old tax regime. So both the regime has the different tax slab rates according to the individual's taxpayer income or based on their annual income. Firstly, we will check here the new tax regime and then old tax regime. First, in new tax regime, what are the deduction that is allowed? What is new tax regime? We will cover here. So the new tax regime is a default regime from the assessment year 2024 and 25, which was the last year. Here, in case if you have missed the due date to file the return, you can still file the belated return in the new tax regime since it's a default regime. Now, what are the deductions that are allowed in new tax regime? We'll go one by one. First is standard deductions. First, as in standard deduction up to 75,000 is allowed in new tax regime, which is updated as per budget 2020-24. As in earlier, it was same as old tax regime. So earlier for last financial year, the standard deduction was 50,000 even in the new tax regime. But as per budget 2020-24, it has been enhanced to 75,000 in new tax regime. Next is home loan interest benefit for the let out property. In case if you have a property which is a let out property, which means you are currently owning that property but you are not staying in that property, then you can claim a deduction under section 24B for the interest component. Narendra has raised the hands. Is there any issues or queries, Narendra?
Yeah, the screen is not changing. The same screen.
Sorry, your voice is not audible.
Madam, the screen is not changing. It is the same.
No. It's the same itself, where we are covering the new tax regime and the old tax regime. My screen is that only, right?
Yeah,
Yes.
yeah. Okay. Okay.
So we'll continue with the home loan interest benefit. As I just have informed you, you can claim the interest component of the housing loan under section 24B for a let out property. I want to highlight one point here. In case if you have a self-occupied property, which means the property that you have owned and you are currently staying in that property. So you cannot claim a deduction in self-occupied property under section 24B in new tax regime. As in, only the let out property we can consider as a deduction in new tax regime. Moving ahead to the other section, which is 80CCD2, which is for NPS investments. So there are three types of contribution in the NPS investments. First is NPS or employer contribution towards NPS fund. Second is employee contribution towards NPS funds. And third is voluntary contribution towards NPS funds. So here in new tax regime, only the employer's contribution towards NPS investments will be covered in new tax regime. Lastly, the Agnivir Corpus Fund. In case if you have invested in Agnivir Corpus Fund, then definitely you can opt out for the deduction under section new tax regime. This is the overview for a new tax regime. Let's move ahead to the old tax regime now. While in old tax regime is a choice or an option regime with the higher rates. So in case if you want to opt out for the old tax regime, which is the old tax regime here covers the deductions and exemptions. And if you want to file the ITR in old tax regime, that must be before the due date. The due date to file the ITR is 31st of July for the particular assessment year. So let's take an example for last year. The due date to file the return was 31st of July 2024. So summarize this. If you want to opt out or if you want to file the return in the old tax regime, you have to file the return before the due date, which is 31st of July for every assessment year. Now let's come to the deduction which are covered in old tax regime. In old tax regime, as we discussed earlier, 50,000 rupees of standard deduction is allowed. Next is home loan interest deduction to both self-occupied as well as the let out property allowed, and other deduction, as in there are 72 other deductions that are allowed in the old tax regime where you can claim and in old tax regime and maximize your savings and minimize your total taxable income. The difference between the new tax regime and the old tax regime here is in new tax regime there are the certain restrictions on the deductions and exemptions. There are only few deductions which we have already covered that are allowed in the new tax regime, and in old tax regime you can enjoy the benefit of all the tax regime tax exemptions beneficial for every investments and others. So here I want to highlight one point that as per the old tax regime or as per the new tax regime, the old tax regime has a higher slab rates. Just because in old tax regime, we are considering all the types of various deductions and exemption where we are reducing our total taxable income and enjoying the benefit for the deduction which we have claimed. Moving ahead to the slab rates. So there are three categories for prescribed by the government for the slab rates. So first category is the individuals whose age is below 60 years. Second category, the senior citizen whose age is between 60 to 79 years, and super senior citizens whose age group is 80 years and above. So in case if you have the seniors, if you have the individuals whose age is below 60, what will be the tax slab rate in new tax regime and old tax regime? We'll see now. In new tax regime, the slab rates for all the categories are same, and this is very simple. As in new tax regime, the slab rates are not described or prescribed by the age group. It is simple and same for all three categories. Let's understand what is the slab rates in new tax regime. So here up to 3 lakh, there is no taxes. From 3 lakh to 7 lakh, 5% tax will be applicable. From 7 lakh to 10 lakh, 10% tax will be applicable. From 10 lakh to 12 lakh, 15% tax will be applicable. From 12 lakh to 15 lakh, 20% tax will be applicable. And above 15 lakh, 30% tax will be applicable. Where you can see the new tax regime slab rates. But here is a catch again. So in case if you have an income which is less than 7 lakh, or if you have an income which is less than 7 lakh, then there is no taxes on the income in new tax regime. Suppose you have an income of rupees 6 lakh and you are opting out for a new tax regime, you don't have to pay any taxes and you are getting the rebate under section 87A. Now, what are the tax slab rates for the old tax regime? So we'll go one by one here. For the individuals whose age is below 60, up to 2.5 lakh, there is no taxes anyways for them. From 2.5 lakh to 5 lakh, 5% tax will be applicable. From 5 lakh to 10 lakh, 20% tax will be applicable. And above 10 lakh, 30% tax will be applicable for them. For a second category, which is a senior citizen whose age group is 60 to 79 years, up to 3 lakh, there is no taxes. From 3 lakh to 5 lakh, 5% tax will be applicable. From 5 lakh to 10 lakh, 20% tax will be applicable. And above 10 lakh, 30% slab will be applicable to them. For the third category, which is a super senior citizen whose age group is between 80 to 80 years and above. So for them, up to 5 lakh, there is no taxes. From 5 lakh to 10 lakh, 20% tax will be applicable, and above 10 lakh, 30% tax will be applicable for them. So here, if you can see, in old tax regime, for the first category, whose individual below 60 years, up to 2.5 lakh, there is no taxes. For a senior citizen, so whose age is between 60 to 79 years, up to 3 lakh, there is no taxes for them. And in case if you are a super senior citizen, then up to 5 lakh, you don't have to pay any taxes on your income. Here you can see the tax slab rates in new tax regime and old tax regime. And in new tax regime, as compared to new tax regime, the old tax regime has a higher slab rates. Move ahead to the identify the right tax regime for you. So here, which regime is beneficial for you? You have to choose that things very wisely while filing the return and while submitting the declaration to your company so that they can deduct and calculate your taxes accordingly. So first feature here for a senior citizen is in case for a old tax regimes allows the multiple deductions and exemptions like ATC, ATD, home loan interest, which can be beneficial for you if you are eligible investments and if you have a sound investments with your end. While in new tax regime, simplifies the filing, but it is the beneficial only in case if you don't have any other investments or if you have a zero investments with your head. What are the tax rates? As we have already discussed, according to the new tax regime, the old tax regime has a higher slab rates since in old tax regime we can claim all the deductions and exemptions. Next is to summarize this. If you have a sound investment with your end, then you can definitely go ahead with the old tax regime. And in case if you have the less investments or zero investments, and also if you want to simplify your tax filing, then you should go ahead with the new tax regime here. Moving further to the budget update. So there are certain budget updates from 2020-24 and there are certain budget updates from 2020-25 as well. So we'll see first what is the budget update for 2024. Again, here we will go one by one. Let's understand what are the budget 2020-24 here now. First is revised tax slab rates. So the slab rates have been revised in budget 2020-24 to boost the income for the individuals and to boost the income for the investments for the individuals. The slab rates which we have already covered, it is for the budget 2020-24. Next is standard deduction. As discussed earlier, the standard deduction has been enhanced from 50,000 to 75,000 in new tax regime, which reduces your total taxable income and increase your in-hand or take-home salary over here. Third is buyback taxes. So if you are buybacking the shares, in that case, earlier it was taxable in the hands of a company. But as per the budget 2020-24, it will be taxable in the hands of shareholders or the investors, which reduces their return on their investments. Next is capital gain taxation. As most of the people know that the limit for the long-term capital gain taxation has been increased from 1 lakh to 1.25 lakh, and the rate of return for the long-term capital gain will be increased from 10% to 12.5%. Next is NPS deduction. So, and earlier the employer's contribution towards NPS investments was 12% in new tax regime and 10% in older tax regime. But it has been enhanced, or it has been increased to 14%, which enhanced the retirement savings with the tax benefits. Coming up next to the securities transaction tax, which is STT. Now, STT limit has been increased. So, STT is covered, or this STT is for the person who is dealing or trading with the futures and options. So, who is investing in futures and options. This will impact their return on their investments since the STT limit has been increased. Lastly, the angel tax. So angel tax is a tax which is levied on the startup companies. So in case here, as per budget 2020-24, the angel tax has been abolished to potentially increase their investments in budget 2020-24. Now there are certain updates, budget updates from 2020-25 as well. Again, we'll go one by one here. First, income tax simplified by half of the section and chapters as that Income Tax Act 1961. So the government has simplified the half of the sections of the Income Tax Act. So even the common man can understand the acts and exceptions and deductions, so on. Second is the TDS to be rationalized rate, reduce threshold limits, increase 194I, increase to 6 lakh. So there is an increase in threshold limit under section 194I. 194I is related to the rental TDS. So the TDS which is deducted on a rental income. So earlier the tax limit was 2.4 lakh, but now it has been increased from 2.4 lakh to 6 lakh. Next is LRS scheme TCS increased to 10 lakh. So the threshold limit for collecting the TCS for LRS has been increased or has been raised from 7 lakh to 10 lakh. Next update is higher TDS limit to apply only in case of non-PAN cases. So in case if you are a person who do not have PAN till now, or in case where the taxpayer do not provide PAN, in their cases the higher TDS will be applicable. Fifth is the time limit for filing updated return extended to 4 years from the present 2 years from any assessment year. So this is one of the good options or good change by the government. This time limit to file the updated income tax return has been extended from 2 years to 4 years from the end of the assessment year. So if you have missed the filing for the last assessment year, you can still file the return for last 4 assessment year. Sixth is two self-occupied properties can be claimed as a deduction from house property without any conditions. So earlier, only one house property can be considered as a self-occupied property. Now we have an option that only the two occupied properties we can consider as a self-occupied property, and we can claim a deduction under section 24B for an interest component without any conditions or limitations. Moving ahead to the other budget updates, which is budget 2020-25. Seventh is startup benefit extended till 31st of March 2030. As we have already discussed, the angel tax, which was being abolished by the government for startup companies, has been extended till 31st of March 2030. Next is personal income tax reforms with the special focus on middle class. So earlier the basic exemption limit was 7 lakhs, but now the basic exemption limit has been increased from 12 lakh, 7 lakh to 12 lakh. So which has been enhanced for the individuals. So here they can take, or here you can increase in the take home salary of the individuals as well. Next is basic tax exemption limit has been increased from or extended till 12 lakhs. So as I just have mentioned that basic exemption limit has been increased from 7 lakh to 12 lakh. Higher rebate benefit not available for special income. So there are special income which is known as special income, like the if you have traded in short-term capital gain, if you have an income from lottery, or if you have an income from the online games, that which comes under special rate, or which known as a special incomes. So this rebate, it is an A rebate, will be not be allowed for the special rate incomes, and the tax will be calculated accordingly to them. We have already covered the slab rates for the budget 2020-24. So now what are the slab rates for a budget 2020-25 as well, we will see here. So the tax rate here is 0 to 4 lakh, there is no taxes. 4 to 8 lakh, 5% tax will be there. 8 to 12 lakh, 10% tax will be applicable. 12 lakh to 16 lakh, 15% tax will be applicable. 16 lakh to 20 lakh, 20% tax will be applicable. 20 lakh to 24 lakh, 25% tax will be applicable. And in case if you have an income which is more than 24 lakh, then 30% tax will be applicable in this scenario. Lastly, the budget update for 2025 was the TDS deduction limit increased from rupees 50,000 to 1 lakh. So for the 80 TTB, the deduction for a senior citizen, the deduction for a senior citizen comes under 80 TTB for their saving bank interest, for their FD interest, for their recurring deposit interest. So here the limit to claim such deduction earlier was 50,000, but now in budget 2020-25 it has been enhanced to 1 lakh, which leads to increase the savings of the senior citizens basically. So these are the budget updates from the budget 2024-25 and 2025. Let's move ahead to the introduction to the senior citizen tax benefits. So here we'll cover who is a senior citizen, what are the importance for a tax benefit for a senior citizens. So an individual resident who is 60 years or above in age but less than 80 years at any times during the previous year is considered as senior citizen for income tax purposes. A super senior citizen is an individual resident who is 80 years and above at any time during the previous year will be considered as super senior citizens. So here in case if you are below 6, if you are more than 60, or if your age is more than 60 years or 60 to 79 years, you will be considered as a senior citizen for the taxation purpose. And in case if your the age, or if your age is more than 80 years and above, then you will be considered as super senior citizen for the taxation purpose. Let's understand what are the importance of the tax benefits for a senior citizens. So first is to ensure the financial security in retirement. Tax benefits or tax planning plays a very crucial role in ensuring the financial security, especially during the retirement. One of the primary reasons for this benefits is to provide the financial security to the senior citizens at the time of their retirement, where the income is fixed and limited. The second importance is to support older citizens with rising living cost. So the tax benefits help the older citizens to manage their finance efficiently and effectively. Third importance is the design to reduce the tax burden for seniors. So there are the provisions which are designed to reduce the tax burdens for seniors and allowing them to save further. Lastly, to create the additional source of income. So this is the another important advantage for a tax benefit, by creating an additional source of income by strategically utilizing the tax benefits helps senior citizens to comfortably and secure. We have covered here the senior citizen tax benefits and what are the senior citizen tax benefits and what is the importance of the tax benefits to the senior citizens. Let's move ahead to the key tax benefit for a senior citizen. So here the increased basic exemption limit. So for senior citizen, as we just have covered, for senior citizen whose age group is between 60 years to 79 years is considered as senior citizens. So for senior citizens 60 years and above, the basic exemption limit is higher than the other individuals. That is, the seniors enjoy the limit of 3 lakh. versus 2,50,000 for others. So as we have already covered, the 3 lakh is the basic exemption limit for a senior citizen whose age group is more than 60 years or 60 years to 79 years. Wherein if the individual who is below 60 years, then the basic exemption limit here is 2.5 lakh. Consequently, any senior citizen with a total income up to 3 lakh is required to pay any income taxes. So basically here, in case if the senior citizen has the income which is up to 3 lakh, then there is no taxes will be applicable in their cases. Coming ahead to the section 194P, 194P of the Income Tax Act 1961 provides the condition for exempting senior citizen from filing income tax return age 75 years and above, which means section 194I was introduced to simplify the tax return filings process for a senior citizens, and it is specifically for the resident senior citizens whose age is more than 75 years and above, and who has only the pension and interest income from his end. Under this provision, seniors can exempted from the filing an income tax return if their income is only from the pension and interest received from the same bank, and if they don't have any other source of income apart from the pension and the interest income. Here, the senior citizen must declare their income to the specified banks. So the central bank notifies certain banks to handle these provisions, ensuring the compliances and calculation for a tax liability for a senior citizen. So here the bank will be deducting any the TDS based on the applicable slab rates for the senior citizen after considering the eligible deduction and rebates. Here, for better understanding, let's take an example. So, Mr. A, whose age is 76 years. So, here, since the age is 76 years, he is eligible to get a deduction under section 194P for exempting the, or it simplifies the income tax return for them. So, Mr. A, whose age is 76 years and above. So, here he has the two sources of income. First source of income is his interest income, and second source of income is his pension income. So in case if he has a pension income of 4 lakh, and in case if he has an interest income of 1 lakh, so your total taxable income for Mr. A is 5 lakh. Here we have already discussed that there is a basic exemption limit for the senior citizens up to 3 lakh. There is no taxes for their income. So if you see, from 5 lakh, this was the total taxable income for Mr. A. From this, we will deduct the basic exemption limit, which is 3 lakhs. So now for Mr. A, the total taxable limit is, or total taxable income is 2 lakh. Here, in case Mr. A has the total taxable income of only 2 lakhs. So he is not eligible to pay any taxes since his income is less than 5 lakhs. I hope this will be clear for this section 194P with a better understanding with the calculation with the example. Let's move ahead to the third point, which is a senior citizen who are not run any businesses are exempt from paying the advance taxes. So advance tax is a tax where you are paying to the income where you have not paid any taxes. So if you see, if you have a income from salary or if you have an income from interest income, so you might know that you are earning an income. In that case, you have to deduct the taxes, or in that case, you have to deduct or you have to pay some advance taxes. So at the time of filing, you won't be paying any burdens or you won't be paying any interest or penalties. We have already covered the key tax benefits for the senior citizen. Now let's understand what is the various deductions for senior citizens in various sections. So firstly is in ATC. Seniors can claim the deductions for investments made in specified financial instruments such as PPF, which is Public Provident Fund. Second is National Savings Certificate, and third is Life Insurance Premium. So firstly, we'll cover the PPF. So PPF is the investment option. If you are looking for investments, which is a long-term investment, and with the list is that you don't have to take any risk, then PPF is one of the best investment option for you, where you can claim the deduction up to 1.5 lakh in ATC for the investments that you are making here. The return on the investment here is around 7 to 8% with a lock-in period of 15 years. Coming up next to the National Savings Certificate. This National Savings Certificate is a government-backed scheme which is suitable for a low-risk investors. Again, the person who don't want to take a risk, they can invest in a National Savings Certificate as it offers the guaranteed returns with the tax benefits. And the maximum deduction here you can claim under Section 80C is 1.5 lakh. The return on this investment, so rate of interest which you are getting from here after making the investment is 7 to 8%, which is at least good as compared to the bank FD, which has a lock-in period of 5 years. Next is life insurance policy. Now, most of the people tends to have the life insurance policy, not just for saving the taxes, but also to secure the future of their family, which is dependent on them in under the unforeseen circumstances. So here, the maximum limit for all three instruments or financial instrument, or we can say the investment option, the maximum deduction is 1.5 lakh for all three, which covers under Section 80C. Moving ahead to the Section 80 TTB, which is for interest on deposits. This is one of the most negligible income for the individuals, as most of the people don't know that their saving bank interest and FD interest and other interests are also taxable. So in this scenario, they can claim, or the individuals or the seniors can claim a deduction up to 50,000 on interest income from saving bank accounts, fixed deposits, and recurring deposits. In case if you have a saving bank interest or fixed deposit or recurring deposit interest, then you can claim a maximum deduction of 50,000 under Section 80 TTP, which we have already covered in budget 2020-25. It has been enhanced from 50,000 to 1 lakh. Here we have seen the deductions for senior citizens. Now let's see what are the additional deductions and benefits for the senior citizen under other sections. So first is Section 80D, which covers the health insurance premium. Senior can claim the higher deduction on premiums for health insurance under Section 80D, which is a 50,000 deduction for seniors. So in case if you are paying any health insurance for yourself, and in case if you have a medical expenses for yourself, you can claim under Section 80D. Since you are a senior citizen here, you can claim maximum up to 50,000 as a deduction in 80D for your health insurance premium which you have paid from your end. Next is higher deductions that are allowed in 80DDB. So Section 80DDB provides a deduction to an assessee in the occasion of the expenses on medical treatment of specific alignments. Normally, this deduction is allowable up to 40,000. Nevertheless, if the patient is a senior citizen, then a deduction of 1 lakh is permissible, which means the 80DDB covers the expenses which is related to the certain disease for yourself or for your family members. So in case if you have a specified disease like a neurological disorder or AIDS, then you can claim a maximum deduction up to the 40,000 in case if you are the not a senior citizen, if your age is below 60. But in case if you are a senior citizen, then the maximum deduction will be allowed here, which is 1 lakh. You can claim 1 lakh as a maximum deduction under Section 80DDB, which covers the medical expenses for a specified disease. Here we have verified or where we have learned these additional deduction and benefits under various sections. Moving ahead to the senior citizen savings schemes. So what is senior citizen savings scheme first? Senior citizen savings scheme is a government-backed retirement scheme that is considered to be safe and most reliable, which is specifically for a senior citizen. The scheme offers the regular income with interest, which is particularly paid on a quarterly basis. Quarterly basis as in you are getting the interest here every 3 months. On an year, in year you will be getting 4 times from the interest from the senior citizen savings schemes. The maximum limit for the investment here is 30 lakh. And the maximum deduction you can claim up to 1.5 lakh in ATC deduction for yourself. So in case if you are making the investment in senior citizen savings scheme, the maximum that you can invest here is 30 lakh, and the tax benefit under section ATC you can get by investing in this option is 1.5 lakh. Here we have covered the features of senior citizen savings schemes. Let's move ahead to the introduction to the tax planning for the senior citizens. So let's understand why tax planning is important for senior citizens. So seniors often lives on the fixed income from the pension, savings, or the retirement funds. So tax planning is very important for seniors since they are living on a fixed income from pension, savings, or the retirement funds. Second is proper tax planning can help maximize retirement savings and reduce the total taxable income, and alternatively minimize the taxes and maximize the saving of the investors or senior citizens. Here, the main objective of this tax planning for the seniors to preserve their wealth, maximize tax savings, and ensures long-term financial stability for themselves. Here we have covered why this tax planning is important for a senior citizens. Moving ahead, we'll see what are the advantages a senior citizen can take under various sections and exemptions. First is increased exemption limit for seniors. So, as we have already discussed, a senior citizen whose age group is from 60 years and above, the basic exemption limit is often higher than the standard basic exemption limit for the other taxpayer, which is 3 lakhs. So, for senior citizen up to 3 lakh, there is no taxes. For the person who is not a senior citizen, then up to 2.5 lakh, there is no taxes for them. In case of a super senior citizen whose age is 80 years and above, the higher exemption limit for very senior citizen or for a super senior citizen is 5 lakh. So here in case if you have an income which is up to 5 lakh, then there is no taxes on your income. Here, the action plan for ATC investments and other investment, so ensure the limits of maximize the tax savings, and this especially beneficial for those with a fixed and limited source of income. So here you can, as you can see, since the senior citizens are getting the fixed incomes, they can reduce their tax liabilities, and if their income is less than 3 lakh, then there is no taxes for them. Moving ahead to the maximized deduction under section C. So where a senior citizen can save the maximum in under section ATC, or the tax saving through the investment section ATC deductions. So invest in tax saving instruments, like apart from this, the which we have covered earlier, there are the other deductions or investments which covers under ATC, which is PPF, ELSS, and NSC, to reduce their taxable income. Like if you can invest in PPF, ELSS, and NSC, that will also cover in ATC, which has a maximum limit of 1.5 lakh. Here, as we have already discussed, here the maximum deduction we have claimed is 1,50,000. And the tax saving strategy here is you can use your ATC investment fully up to 1.5 lakh by investing in every other options like the ALSS, PPF, PF, NSC, and others. So here we have covered the maximum deduction under section ATC. Now let's move ahead to the invest in senior citizen savings schemes. So earlier we have discussed what is senior citizen savings schemes, what are the features of the senior citizen savings schemes. Here we will discuss what is the benefits of a senior citizen savings schemes. A senior citizen savings scheme is a safe and government-backed scheme specifically for senior citizens, with has a attractive interest rate with quarterly interest payments. So as we have already discussed, the interest here is based on a quarterly basis. You are getting the interest here on a quarterly basis. Here, the tax benefits are the interest which you are earning here from this investment is taxable, but the contribution towards the senior citizen savings schemes are eligible for the deduction under section ATC. So in here, the interest which you are getting from the senior citizen savings schemes will be taxable here, but the investment which you are making here will be considered as a deduction up to 1.5 lakh in ATC. Action plan for senior citizen savings scheme is you can consider investing in senior citizen savings schemes if you are looking for a safe investment option with a steady returns. And it's best for the investment option for conservative investors who don't want to take much risk. Here we have covered the investment and how and what is the benefit to invest in if you're investing in senior citizen savings scheme. Let's move ahead to the other deduction, which is maximized deduction for health insurance under section 80D. So healthcare covers or healthcare savings. Healthcare savings which covered under section 80D allows the seniors to claim higher deduction for health insurance premium. So here, as we have already discussed, if the person who is more than 60 years and a person age group is between 60 to 79 years, they can consider as a senior citizen. And the person whose age is below 60 years will be considered as a non-senior citizen. So this ATD covers the health insurance premium which is paid by you for both the senior citizen as well as the non-senior citizens. So first up to 25,000 for non-senior citizens. So in case if you have paid the health insurance for yourself and for your family members and for your dependent child, and in case if you are a non-senior citizen, then up to 25,000 your maximum you can claim as a deduction. Wherein up to 50,000 for senior citizens. So in case if you are a senior citizen, if you are paying the health insurance premium or for a medical expenses, you can claim up to 50,000 for senior citizens. The maximum annual deduction here is 75,000 if you are claiming both the deductions. So in case if you are an individual who is not 60 years and above and who is a non-senior citizen, if you have paid the health insurance for yourself, then up to 25,000 for yourself and family members. And in case if the parents are senior citizen, then up to 50,000 additionally you can claim here. So this comes to the 75,000 maximum deduction in case if you yourself is not a senior citizen, but if you are paying the health insurance for your senior citizen parents. Action plan here is for the ATT deduction is to ensure you are taking full advantages of this deduction by purchasing the comprehensive health insurance plan for yourself and for your family members, which means you can review your current health insurance policies to ensure that they are providing the adequate coverage, or alternatively if they needed, you can upgrade your plan and more comprehensive plan to maximize this deductions as well. Here we have covered the maximum deduction which is allowed for health insurance under section 80D. We'll move ahead to the other thing, that tax planning tips for the senior citizens. So what are the tax planning tips for a senior citizens? So first tip is plan for tax-free incomes, which consider tax-free income source like tax-exempt interest in Provident Fund, Sukanya Samriddhi Yojana or National Pension Savings Schemes to save the taxes and maximize your return as well by making the investment in such options. Second is optimize withdrawal strategies. You can plan your withdrawals based on your financial goals and tax provisions to minimize your tax liability as well. Third tip is to consider the income splitting. If possible, consider splitting your income so that it falls in the lower tax bracket to reduce your tax liability and taxable income. Here, the action plan is work with the financial advisor and tax planner to implement the strategies based on your income and tax situations. So why the tax, we have already covered why the tax planning is important. Here, considering this tax planning tips for a senior citizens, you can advise or you can have a financial advisor who can plan your taxes according to your income and tax situations. Here we have covered the tax planning tips for our senior citizens. Now let's see, there are the other chapter 6A deductions which are covered under chapter 6A, which has the other maximum limit as well, which is over and above the ATC and ATC as well. So let's understand what are the other investment that are covered under ATC as well. First, ATC is mostly the ATC is the most common and favorable for every individual who are going to make the investments in ATC. Most of the people have already made the investment in ATC knowingly and unknowingly by making the investment in PF, LIC and others, so which will be covering in ATC investments. So there are two categories for this ATC investments. So first category is where you are incurring the expenses and claiming the deduction, such as paying the principal amount of housing loan or a tuition fees for your children or a LIC premium for your child or the family members, or in case if you have purchased a housing property, the stamp duty must be also paid by you. So this expenses you can cover in ATC deduction, where you can save the taxes in old tax regime and reduce your tax liability. The second category is will also helps you not just for the tax saving purpose, but also can create health or wealth via investing in such good options, since the return on these investments are good. First, we'll see what is ELSS. So ELSS is equity linked savings scheme. If you are looking for a short-term investment, then ELSS is one of the best investment option for you. Since the ELSS has a lock-in period of only 3 years and maximum deduction you can claim here is 1.5 lakh in ATC. But here, since you are making the investments in the capital market, the risk will be involved here. Additionally, the return on this investment will be 12 to 15%, which is a good investment or good returns which you are getting by investing in ELSS options. Here, there are the other deductions which we have already covered, but I'll just quickly update you regarding those deductions which we have already covered, like LIC, EPF, and PPF. LIC premium, which is paid by you for yourself and for your family members, will also covered in ATC, which has a maximum limit of 1.5 lakh. Next is EPF, which is an employee provident fund. So if you are making the investment in provident fund, this will be also covered in the ATC, which has a maximum limit of 1,50,000. And for most of the people, their EPF investment itself covered the ATC investment of 1.5 lakh. Next is PPF. So public provident fund, we have already covered where you can claim a deduction maximum up to 1,50,000 by investing in PPF, which has a lock-in period of 15 years, which covers under ATC. Now, principal amount of housing loan. So here, if you are paying a housing loan, so you must know the housing loan contains the two types of contribution, like the principal contribution and the interest contribution. So the principal contribution which you are making the payment for, or the principal which you are paying for the housing loan, will be covered under section ETC, which has a maximum limit of 1,50,000. Next is a senior citizen savings scheme, which we have already covered, which will be covering in ATC, which has a maximum limit if you are making the investment in senior citizen savings scheme is 1,50,000. And here the lock-in period is 5 years. Next is NPS schemes. So in case NPS helps the individuals for their long-term retirement planning. So if you are looking for a long-term investments with the retirement benefits, then NPS is one of the best investment options for you. So as discussed earlier, there are three types of investments in NPS. First is employers contribution towards NPS, employee contribution towards NPS, and voluntary contribution towards NPS. So in ATC, employees contribution towards NPS will be covering here, which has a maximum limit of investment, which is up to 1.5 lakh, and in covers in ATC. Next is National Savings Certificate. As we have already covered, the National Savings Certificate is also a government-backed scheme, which has a lock-in period of 5 years. And here you can make maximum claim as a deduction up to 1.5 lakh in ATC itself. And this is the low risk investors, which is for a low risk investor. In case if you have, you don't want to take any risk, then NSC is the best investment option for you. Lastly, the Sukanya Samriddhi Yojana. So suppose if you have a girl child, then you can definitely invest in Sukanya Samriddhi Yojana under the government scheme Beti Bachao Beti Padhao. So the idea for this scheme or Yojana is to promote the education for the girl child. So you can make the investment in Sukanya Samriddhi Yojana up to the age of 10 of the girl child. You can partially withdraw the amount when she turns 80, and you can fully amount the you can withdraw full amount at the age of 21 of the girl child. The return on these investments are also good, which is 7 to 8%. And here again, the maximum limit is 1,50,000, which cover under ATC. Now, what are the other deductions that are covered, which is over and above this ATC's deductions? So there is the we have already covered that there are three types of contribution towards NPS. So here the voluntary contribution and the employer contribution towards NPS will see. First option is 80CCD 1B. So NPS investments offer the voluntary contribution towards the NPS investment, which has a maximum limit of 50,000. Sorry. Is there any query?
Ms. Bhavika, you can continue.
Yeah. Okay. So 80CCD 1B covers the NPS investment, which is a voluntary investment, and here the maximum limit is 50,000, which is over and above the ATC investments. Now we have already discussed that this 80CCD2 investments is the investments where your employer is contributing to your NPS funds. So here the maximum limit is for a central and state government employee is 14% of the basic salary. And for other employers, suppose you are not a central or state government employee, then 10% of the basic salary in old tax regime and 14% of the basic salary in new tax regime, which is updated as per budget 2020-24, which will be covered in 80CCD 2 sections. Next is 80D, which covers the health insurance, which we have already covered. If you have a health insurance for yourself, spouse and dependent children, up to 25,000 maximum you can claim here for yourself in this. In case if you are a senior citizen or your parents are senior citizen, then you can claim up to 50,000 for yourself in this. In case if you are not a senior citizen, but if your parents are senior citizens, then you can claim 25,000 for yourself if you are paying the health insurance, and 50,000 for your parents if you're paying the health insurance for your medical expenses and others. That will be covering in 80D, which has a maximum limit of 50,000. Here I want to highlight one point. In case if you are a senior citizen itself, and if your parents are also a senior citizen, then in case 50,000 each deduction will be applicable for you and for your parents as well if you are paying the health insurance or the medical expenses for yourself as well as for the parents. So your maximum deduction is allowed as considered in 80D, which is 1 lakh rupees. Next is 80DD, which is a deduction for the disabled dependent. So here the person who has been disabled and dependent for you, you can claim a deduction under section 80DD. The maximum deduction here allowed is 75,000 if the disability is between 40 percentile to 80 percentile, and in case if the disability is between 80 percentile and above, then 1,25,000 is the maximum deduction you can claim yourself in this for the 80DD deduction. Here, irrespective of the expenses that you are incurring on them, you can claim a maximum deduction for yourself in this. Coming up next to the 80DDB, which we have already covered, the medical expenses on specified disease. So in case if you have a medical expenses for yourself for a specified disease, or in case if you have a specified disease, or for your family members if they have a specified disease, the maximum deduction here is 40,000 if the age is below 60 for yourself. And in case if you are a senior citizen whose age is more than 60 years, then up to 1 lakh, they can claim a maximum deduction under section 80DDB. Coming to the 80TTA deductions, which is a saving bank interest deduction. So in case if you are a non-senior citizen, so which means if your age is below 60, then the maximum deduction here allowed is 10,000 for you. Next is 80TTB, which is for a senior citizen. As we have already covered, the 80TTB covered the interest deductions on the FDs, saving banks, and as well as the other recurring deposit interest as well, where you can claim a maximum deductions of 50,000 for yourself in this, which has been enhanced in budget 2020-25 to 1 lakh to increase the saving for the senior citizens as well. Next is lastly the 80E, which is an education loan. So suppose if you have taken an education loan or a higher education loan for your higher studies, for yourself, for your family members, for your children, then you can also claim the deduction under section 80E for the interest component which you are paying for the EMI or for the education loan. Here there is no maximum limit like other deductions. There are the maximum limit which is prescribed by the government, but for 80E deduction, which is covered for a health education loan, there is no maximum limit. That means that you can claim the maximum deductions or maximum interest which you are paying for your education loan. But if you want to claim this deduction, the loan must be from a recognized financial institution, and the loan must be repaid by 8 years or the loan repayment only. So basically here in 80E, the education loans tends to be end in 5 years only, which will be extended till 8 years. In case if it is more than 8 years, then you cannot claim the deduction in 80E. The maximum deduction will be allowed up to 8 years only. That's it from my side for today's session. So these are some tax saving strategies for senior citizen as well. So how they can save their taxes and maximize their saving itself and take home salary or the income from their end itself.
As we wrap up today's insightful webinar on new tax rules 2025, I would like to extend my sincere thanks to our speaker, Ms. Bhavika Rajput, for sharing her insights and knowledge. Your expertise has been incredibly inspiring and helpful. A big thank you as all to our participants for your active engagement and thoughtful questions.